Hi everyone, welcome back to the slide coverage. I will be spending a few minutes sharing with you the macroeconomic events most relevant for this week and the technical levels we should watch for these days for many years. Okay, anyway, sorry, let me start by sharing the calendar. It's maybe the less relevant because for what I have been seeing these days, the market is not paying too much attention to data itself. It's not reacting exclusively to data, but mostly to what's going on with central banks. We have the ECB easing, the Bank of Japan easing negative rates in Japan last Friday. It really a shock. And last night we have the Australian Dollar Reserve Bank, right, deciding, offering also a dovish stance. I mean, Glenn Stevens, which is the governor of the Reserve Bank of Australia, wants to keep the Aussie competitive, right? We are trading around 70 cents. It's a nice low level for for the Aussie and for Stevens and for exports. So it was no shocker that he had a dovish stance. But anyway, keep that in mind. Central banks are doing what they can to keep their currencies low, except from even the Federal Reserve wants to downgrade a bit the greenback. I guess it's getting too expensive to continue rising rates, and the latest data with the Fed saying on last Wednesday that economic growth has somehow slowed down by the end of 2015, and the fact that we have had a 0.7% GDP reading for that quarter, right, suggests that the economic outlook, the economic growth in the U.S., it's losing steam, right? It's not that we are entering deflation yet or contraction, economic contraction, but yet it's risky. Anyway, we have little ahead for this week in the macroeconomic calendar. And of course, the start will be non-farm payrolls on Friday, right? We have tonight, at the beginning of the upcoming Asian session, the employment report in New Zealand, which tends to affect the Aussie temporarily, guys, okay? Remember that if the report is too good and the New Zealand dollar rises, then the Aussie will follow. And if the Kiwi falls, then the Aussie will also fall. Although in the Kiwi, sorry, uh, whether it is gains or losses, that will be sustainable in time, while in the Aussie, it will probably not. Okay. Anyway, sorry, and for this Wednesday, we have the ECB non-monetary policy meeting. I know it's marked as a 3, but it's actually irrelevant. So far, they did anything that can affect the market in this non-monetary policy meetings. Although the risk is always there, guys. That's why it has the 3 in the calendar, because you don't know what we can get from Draghi, right? The ADP in the US will be probably the most relevant number because although it's not always in line with the payroll, it tends to anticipate whatever will happen on Friday, right? And if you take a look, we are expecting a fall, an important fall in the private sector creation of jobs, right? So that a negative ADP below even that 195 expected could put the greenback under far more pressure. Also, we have the services PMIs on Wednesday, and the fact is that poor PMIs readings coming from the US manufacturing ones have been affecting the market. So if we had anything below those previous 53.7 will be quite also negative for the greenback. We have oil stocks, right? Pretty interesting the fact that oil is retreating towards $30 a barrel and the currencies are not in the usual follow through, right? We are going to talk about that when we take a look at charts. Anyway, the Thursday will bring the super Thursday in the Kingdom with the range decision, the vote of the MPBC, the quarterly inflation report, the 8 minutes, and the Carney speech, right? All in one we are having these days. The fact is that is expected to be a non-event, to be honest, guys. It's not expected to be much more than that, okay? We are waiting for them to offer nothing new to the market. I don't know. The market has been trading the pound uh, on the back of uh, during 2015, I mean, on the back of hopes that the United Kingdom will be following the years in a rate hike, and all of a sudden we have currently delaying the rate hike by late 2015. And in his latest wording has been, now it's not the time to raise rates, right? So that's what's behind the recent pound weakness. Although for what we are seeing from a technical point of view, the UK currency seems ready to recover some ground and seems to have set an interim bottom around that 40.80 post last week. Anyway, we are going to take a look at that in the charts, okay? Tomorrow we have also the initial shoveless claim and continued ones. It's usually relevant the day before payrolls, of course. So take a look mostly at the 4-week average, right? The 4-week average will be the one that the market will pay more attention, and it's not actually the calendar. I will ask for it now. But in the meantime, as I was saying, the market will probably focus its attention in here, right? And from payrolls, 190 is expected. Unemployment rate is expected to remain steady at 5%. I could like to see anything above 220 in here, guys, to sustain the greenback. If we have 190 or below, that won't be very positive. Another important factor are wage, because lately wage had been show no growth, right? Well, that's what we have in December, 0% growth. And if we have no higher salaries, you have no inflation. And if you have no inflation, you have no rate hikes. You know that the Fed has said something like it's it's possible that we have 4 rate hikes this year, right? But if things kept getting worse, we are not going to have those 4 rate hikes, okay? And that's what the market will be looking for. Anyway, let me change to charts and see and take a look at them and discuss about the levels and what's going on with the market. See what I'm saying? Oil is around 30 a barrel. And the Canadian dollar, despite slightly higher in the short term, it's well above its daily opening. The OC, it's mostly being harmed by Stevens, and the pound is completely ignoring the oil's decline, and it's above 44 and pressure in the highs. Anyway, let's go. I know I watch the market as a whole. I can't watch one single pair or one single asset at a time, Anyway, let's take a look at the euro. It's the one less clear, less neat for me these days, because we are still trading below this 950, 980 region. Where, if you take a look, we have been below that level since mid-December, right? The level continues capping the upside. Selling interest on approaches to that region results in a decline towards the base of the range around 800, right? We have a low being set by Draghi early January, in January, sorry, at 770. That's the base of the range. And take a look at the moving average, right? They are all together 20, 100, 200, all in 20 pips range and horizontal. That's telling me that there's no directional strength in here, okay? And we have that trend line. And if I turn to the daily chart, let me enlarge it a bit, you will see that we also have in there the 100 simple moving average. So it looks pretty messy to the upside, right? And with no actual strength, the daily 20 simple moving average is pretty much horizontal. That's telling me what's going on in here. Anyway, I know I have said this plenty of times, but to be honest, sorry. I would like the pair to take this level. And if it does, then take this December high, 1059 for me, 1060 region, to offer a more constructive scenario, more bullish euro, right? And of course, we need to take this 780, 770 to talk about bearish one. And if we keep on trading within the range and wait for payrolls around 900. There is little chances that it will be able to break any one of those extremes with the report. Moreover, because let me tell you something, and this is just an educated guess, right? Employment has been the less of a concern of the Fed. Employment has been the reason why we have a rate hike, right? Because inflation, any Fed decision is based on inflation and employment. And if you take a look at employment, it has been steadily growing for the past 2 years, while inflation had remained subdued. So the payroll has become less relevant, okay? Less relevant. So my take is that we haven't actually had one bad number, right? That will have more chances of moving the market and sending the dollar lower, because now the Fed will have two things to care about, inflation and employment. But if the reading is stronger than expected or positive, that won't be enough to give the greenback the boost it needs to break below this low, okay? And that's just an educated guess. Anyway, we are 48 hours away of the report, so actually we are not, we have no clue where the price will be then. Anyway, that's it for the euro. In the meantime, we have some support around 880 short-term ones, 845, which is this Fibonacci support, and the 800, 780 region where buyers have been defending the pair. And honestly, sellers around 960, 80 are the key for me today. Okay. Anyway, and the pound is looking more and more bullish for me. Daily basis, I had this trend line draw and removed it when it broke below it last week, right? It broke below it. But anyway, now that the price is recovering, now that we're reaching higher highs, it seems a bit more bullish for me. In this particular case, it seems that, as I was saying, an interim bottom has been set, and there is a good chance of recovery 45. Okay, that's the next resistance I will take care of in the short term. Sorry, if we take the high around 44, 43 we have set earlier today. Overall, I don't see the pair bullish. This looks just as a correction. Given that, take a look at this. We are barely approaching the 38.2% retracement of the latest decline if we recover up to 45. Furthermore, in this forward chart, I use this 200 exponential moving average, which is a major resistance or support in the case of pound, particularly when it has a slope. Take a look at charts historically. The price always had around this moving average, has a tough time to break either weight of it, but usually when it does and the moving average gains slope, it tends to lead the way. Okay, now the moving average is losing partially its bearish slope, so that's telling me that it's reflecting, in fact, right, that the bearish potential is easing. But I would really like to see the price recovering about this 45.20 level sorry, to confirm that we are going to see a stronger recovery in pound. Okay, and that will depend on whatever Carney has to offer on Thursday. Anyway, and in the short term, as I was saying, 44, 45, 45, 90, 44, 90, 45, 20, sorry, those are the resistance levels to watch. And in the short term, 460 is the immediate, 4360, sorry, is the immediate support. And then the low set around 4325, okay? If we break below the 20 simple moving average in the forward chart, which is also usually a strong and dynamic intraday support or resistance, taking with this chart and how many times it has been rejected from there, then it turns flat, price hovers around it, and when it starts to turn bullish, it becomes a support, right? It's not maybe giving you buying or selling signals, but it's telling you where the market's rate is, so it's quite relevant for me. Okay, and when it comes to the Japanese yen, my we had this 300 pips rally on Friday following Kuroda's surprise to cut deposit rates into negative ground. Yeah, And I was watching particularly this 200 simple moving average in the daily chart, which is the highest the pair has reached and capped the rally, right, ever since the announcement. If you take a look, we have stalled around it on Monday, on Sunday, and all of a sudden we are trying to break lower, right? I do believe that this limited Shen strength we are seeing these days maybe because of China and the poor data we are getting from there and some risk aversion, which is weighing on stocks and commodities, right? And seems to be favoring just the Japanese yen and on gold. Anyway, we have a major support around this 2060 region because we have the 61.8% retracement of the latest daily decline and the 100 simple moving average in this daily chart also, which should contain a bit the slides, right? Anyway, the pair is extremely overbought and needs to correct. What I was watching both in the 4 and the 1 hour charts, right? It's that the technical indicators, take a look at the 1 hour also, right? We have already corrected those extreme readings, right? And in here too, okay, we have corrected the momentum is back towards that 100 level. And despite such huge correction in technical indicators, the price has held pretty well above that 2060 level, which for me is pretty significant and supportive of a bullish case, you know. Anyway, and for these upcoming hours, we have, an immediate resistance around 21, which for me is the first one, followed by that spike at 21.65, right? If we take the level, then I would expect the pair to regain the 22 level, although it seems unlikely we're going to see such movement today. I'm not seeing what can strengthen the greenback that much. Maybe tomorrow with the ADP, if stocks recover some ground. Stocks, we are in the middle of earnings season, so that means stocks can go higher or lower, of course. But anyway, if stocks go higher, that will bring some relief in here and help the pair advancing. Anyway, renewed selling interest below the daily low 2035 for me. Good offer a possible bearish move towards a 50% retracement of the same rally as 1975, and therefore signal further weakness in the dollar Japanese yen. Okay, as I was saying earlier today, the OC has been hit by Stephen's dovish stone. I was taking a look at this chart, and there's sort of a roof been set right in this region, 61.8% retracement of the latest rally. The pair has approached the level 3 times and failed 3 of them, and it's now in the 4-hour chart trading below the 20 simple moving average and aiming to break below the 200, right? It's the same 200 exponential moving average. Remember I told you in pound how nasty the pair gets, so the price gets when it's around it, and how it tends to rise when it's above it. Anyway, the moving average is flat, right? So that's telling me there's still no direction of strength. And if a price manages to extend its rally below this previous weekly low around 70.40, 70.40 is a major support level. I have been talking about this in my daily reports for I don't know how long, but at least a couple of weeks. Anyway, if we lost that level, the risk will turn towards the downside, okay, guys? And we will probably slid back below the 70 figure without much hesitation. And of course, the level to watch to the upside will be this high 71.40 also. And if we take them with payrolls, with employment, with, I don't know, with, stocks, risk appetite, risk aversion, whatever the trigger is, I would expect the pair to complete a 100% retracement towards this January highs in the 73.30 region, okay? That's there. And remember we talked about gold, last week, and the fact that it's given signs of bottoming and giving around the floor. And despite the weekly movements have been pretty shy, the fact is that we are still advancing in the air, right? I don't know. I do believe that most of this is being supported. The bullish case in here is being supported by the fact but the market is already pricing in maybe less than 4 rate hikes in the US this year, right? With tepid data. Anyway, the bullish potential has stalled at this point around 11:30. Um, and it's not gone, but it's stalled, right? There are no signs that the movement can extend at the time being, but there are no signs either that we can see a strong downward movement right now. So my take on gold is take a look at whatever China is doing these days, because if because if China triggers risk aversion and oil plummets below 30, that can boost the commodity, right? That can give it a nice boost, regardless the Fed. Okay, keep an eye on that. And sorry, and well, crude. I do believe that we have complete a strong corrective movement. Sorry, and if we lost 30, well, you know, guys, what the chart is saying, right? 61.8 breaking back below 23. That means that if we break this below this FIBO support, there's room to go down to that 25 the market was discussing before the summer corrective movement, right? Most of whatever happens in oil these days, I do believe that will depend on whatever we had news on stocks in the US, and if we have more bad news from China. Okay, that's what I'm taking up in the market. Swiss franc, honestly, it's not my favorite currency these days, but what I'm watching is that uh, regardless we have no news about the S&P doing something in the market, we are posting higher highs daily basis and continuously. It's totally detached from a euro dollar behavior, right? They usually trade at some euro, and that's not going on. In fact, they are both rising in the forward charts, which is pretty uncertain, pretty rare, right? And that is driving the euro chart towards its highest since the intervention, right, a year ago. So I do believe that, sorry, it's not the intervention, it's when the Swiss National Bank lifted the peg, right? And I do believe that we are getting some intervention from the bank, taking advantage of the markets these days. I do believe that they are doing it, but they are doing it quietly. So don't try to go against the Swiss these days, because sorry, I mean don't go against bearish in dollar Swissy, okay? Because I do believe that the Swiss franc will have more weekends ahead, okay? Anyway, okay, let me take out the the charts. I believe that that's it for today. I will see you back on Thursday, because we are going to cover with Yohai, the Bank of England. And of course, we are going to be here on Friday with Yohai Dale. I'm not sure if Mauricio, because I believe he's taking some days out. But anyway, we will be here covering live payroll, the US payroll. So see you then, guys. And thank you for being here. Thank you for sharing this time with me. And that's it. Bye bye. See you soon. Okay. Thank you.